Thanks for joining us on Power Lunch. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Ira Dugal. Let's get straight to the headlines. The Indian markets managing to hold on to early gains with almost all sectoral indices trading in the green.
Reliance Industries is one of the top Nifty gainers today after it commissions the world's largest off-gas cracker unit.
CLSA sees a visible earnings recovery among Indian equities this year. Its top buys include large caps like L&T and ICICI.
Police impose Section 144 in certain parts of Mumbai and Thane to ensure that the situation doesn't go out of hand after Dalit organizations called for a Maharashtra Bandh today.
Coming up over the next 1 hour on the show, we will talk about the macro backdrop to the Indian currency markets this year. Jamal Mecklai joins us with his views. We'll talk about the Protect and Grow American Jobs Bill and how it could impact the Indian IT industry with R. Chandrashekhar of NASSCOM, the Bhima Koregaon protest with senior journalist Kumar Ketkar, and we will play out a slice of a conversation with Ian Bremmer of the Eurasia Group on the geopolitical risks in 2018.
Well, they're coming up, but first, the markets, Neeraj is here to take a closer look of how the markets have maintained a fairly positive momentum today.
Yeah, they haven't buckled down, quite unlike yesterday. And the good part about today's session is that the broader markets too are performing well. So that's a good thing. VIX is a bit off. So those are the key parameters. The markets may be off the highs of the day, but still trading well. Broader markets still doing okay. And India VIX is marginally off in the session today. Volumes are par for the course, so no surprises out there. Technology and selectively some technology names have done well. So Tech Mahindra, I saw an HCL Tech out there. A couple of other mid-sized names are doing okay. So technology is making a move. But if you scan the Nifty, top 10 gainers on the Nifty, you will see that there is no one sector which is really having a big impact. It's spread across. There are some commodity names out there, the Hindalcos of the world. I think a couple of oil marketing companies, couple of technology companies, banking names like Yes Bank, etc. So it's spread all over. And aside of Dr. Reddy's, we don't have we don't have a prominent loser in the session today, which is actually a good sign. Just moving on to the broader end of the spectrum, there are select names which have started to make an up move yet again. So Adani Enterprises has broken a 3-4 day downtrend. It's starting to do well. Sterlite Technologies, the last time I saw, was up about 3 or 4%. So again, after a lull period, this one has started to do well, 4.5% higher. Rain Industries continues with its uptrend, so second day in a row it's doing well. But as a pocket, if you look at one space that has done well, I think it has to be fertilizers. I couldn't find any specific peg, but for the fact that DBT is alive and kicking. The pilots, apparently, as per Nilkan Mishra's report, are successful, and maybe the nationwide rollout might be quicker than what people anticipated. So almost all of the fertilizer names, including the larger ones like Coromandel, are doing very well. Smaller ones like Fact, of course, are up about 10%.
All right, Neeraj, thanks so much for that. That's the structure of the markets here at lunch hour. But what's the year ahead looking like? Well, every brokerage has their own view. CLSA has put out their strategy for 2018. They do expect some catch up in earnings from here on and have a list of stocks that they think are the top buys for the year. Darshan Mehta standing by with all the details of the CLSA call. Darshan.
Okay, so CLSA has this strategy report that they have given, in which they have 9 buys and 3 sells. So those are the stock specific views that they have given. But overall on the market, what they're saying is the fact that, they see significant amount of earnings improvement that will come in, and fundraising and the bank recapitalization will aid recovery for the markets going ahead. As far as the markets are concerned, the key risks that they believe are fiscal concerns as well as politics. The two themes that they believe will play out will be housing finance as well as real estate. Now, the Nifty target that they've given for 2018 is 11,400, which is a potential 10% upside that they have. Now, individually, stocks that they have selected, the first one is Crompton Consumer with a target price of 310, a potential upside of 14%. The reason that they believe is the fact that there is significant amount of growth in the housing sector and valuations is fair according to them. Godrej Properties, the target price in excess of 26%. Real estate is a sector that they like. RERA will definitely implement and benefit some of the listed players. HDFC, the largest mortgage player according to CLSA, has a potential upside of 12%, so they are rather bullish on HDFC at this point of time. ICICI Bank is the best pick that they believe in the banking space, with the target price in excess of 22%. They believe that the book cleanup is happening, the NPL cleanup is something that is beneficial. IndusInd Bank also, no doubt, valuations are expensive, but it's one of the fastest growing private banks, and they believe a 26% potential upside is possible possible on the counter. L&T, because of the entire infrastructure boom that is there, will benefit. The target price is in excess of 21%. Lupin, they believe that the warning letter issues may be resolved, and they have a substantial pipeline, so 17% upside is something that they see. M&M is a play on the rural demand for tractors going ahead. A potential upside of 20% is something that CLSA believes will come in. The other ones is NTPC. They believe a potential 16% upside is possible on the power major. The other stocks that they like and are the cells that they have. Shriram Transport, a downtick of 31%. They believe that there is significant amount of downturn that is there. Colgate valuations are expensive according to them. A 7% downside is possible. And finally, HPCL is pretty much at the same price that they have. Colgate, they believe valuations are unreasonable at 39 times, and Colgate and HPCL is pretty much trading at the same price, but they believe that valuations have run up for HPCL going ahead. So these are the 9 buys and 3 sells that CLSA has put out today.
Those are the topics, Darshan. Thank you so much for that. Corporate frenzy to issue rupee-denominated bonds may be dying down. Government bond yields surged after the centre announced additional borrowing plans, making it more expensive for companies to tap the debt market. Divya Patil of Bloomberg News is here with us to tell us why this has happened. Divya, we saw the record run. So is that sort of cooling off? What's the reason behind it?
So top ranges in the market are telling us that the record run is seen fading out this year, and the major reason they have cited is the surge in bond yields to a 16-month high in corporate bond yields after the government announced additional borrowing to offset the impact of slowing revenues. Now what has happened is that due to the surge in bond yields, the rate gap between bonds and loans has narrowed significantly and has made loans more competitive. So there is a high chance that companies may choose loans and not bonds, because of which issuances in the bond market is seen fading.
So this will be the test case, Divya, the test year to see whether the bond markets have actually gained market share in terms of the lending.
Exactly, because in the last 4 years, we've seen double-digit growth of bond issuances, and HDFC Bank, which was the top arranger last year, and Trust are seeing single-digit growth this year, while ICICI Securities primary dealership is seeing no growth at all. They're estimating that companies will sell about 6 trillion rupees of bonds this year as compared to 6.4 trillion rupees last year. But out of all this lot, we have Axis Bank, which was the top arranger for rupee bonds for the past 11 years. And they believe that the record run will continue. Issuances will cross 7 trillion rupees this year. And the major reasons they are citing is that refinancing needs and rules that restrict companies, the amount companies can borrow from banks, will be the major drivers for sales this year.
All right, Divya, thanks so much. We'll see how that plays out. That's the rupee bond story. But what's happening in the rupee markets, or what is likely to happen in the year ahead? What should the rupee markets be focused on? And I say should because the rupee markets listen to what Jamal Mecklai says. And Jamal Mecklai is joining us here on the show today. Jamal, good afternoon. Happy New Year. What's the color of the year? It's green, I see.
Hi.
Hi,
Green. Let's go ahead. It's always green, How are you?
We're very well, Jamal.
Well,
Lovely to
it
have
looks a
you.
little tricky, rupee. Yeah, long time. Well, I mean, clearly the rupee is shocking everybody with its sudden, New Year strength. It would seem that perhaps it's the, the sort of FII limits on corporate bonds, which are going to be auctioned today, which might have generated so much inflows. I'm a little surprised that RBI has not intervened, because, I mean, it's clear that they are concerned about the overhang of unhedged exposures, the sort of pressure on export competitiveness. Towards the end of last year, I thought maybe they were on holiday, but it clearly looks like it's more than that. It could well be that they feel they can't keep infusing liquidity into the system. As you know, they've got lots of purchases of, forward purchases, I think $30 billion. So the market, to my mind, is not comfortable. It's not comfortable for RBI. I think, it's a big trick, right? Because it's, what is it? You're happy when people want to give you money, but it is creating difficulties. I think RBI needs to figure out some way in which they can get the rupee a little weaker. I think one of the things they should look at is they should allow more volatility. As you know, for decades their policy has been we try to contain volatility, and that happened much more so since Dr. Rajan came in, and it seems to have continued with Urjit. So my sense is they need to loosen it, and when the rupee softens, they should let it weaken some more. It's the only way people are going to hedge. People are not going to hedge if the rupee is sitting so pretty, right? Because, you know, my God, everybody's here to save money. But that's as far as RBI goes. I mean, looking a little further into the year, there appears to be lots of sort of clouds of uncertainty. Of course, that's true every year, you know. But this year, what I see is, first off, the whole political story. I mean, you see the riots, not riots, but the problems on the streets right now. The government is really, while, you know, it's done some good things. You know, the GST was good despite the problems, addressing the bank NPAs. Again, it's difficult, but they're doing it. But the whole political, social move, you know, is creating a lot of uncertainty, angst, and I think sooner or later that's got to impact all the markets, rupee being one of them, but all of them. There's 5-6 elections this year. Mr. Modi is fully focused on that. Can't imagine there's any time to think about the country. So I think those wobbles should be, I mean, I can't imagine there will not be wobbles from that. On top of that, you've got the global market. Commodity prices are rising. In the US, people are very excited about the tax cuts. But my sense is probably the deficit is going to be the problem there. And likely you will see rates rising perhaps faster than market expects. So I think we're looking at a situation where something's got to give. And when it gives, of course, everything comes tumbling down.
Jamal, tell me, I mean, so
but when,
last year,
I don't know.
Fair enough. Jamal, last year was a sort of a euro strength story, and again in the first day of trading day of 2018, again you saw the euro jump up nicely because the strength in the European economy seems to be surprising everybody. Could we see that euro strength story and hence dollar weakness, EM strength, sort of that global story continue to play out?
Well, I think you're going to see both moves. I mean, many 2 years ago, I guess, when the dollar first started weakening about 18 months ago or so. At that time, I don't know, it seemed to be that the peak euro strength would be about 125, 126. It's nearly 120 right now. But I mean, that doesn't necessarily mean it'll get to that peak. That was just my view. But I think you will see investment coming into the US. So you will see the dollar getting stronger at some point in the year. Whether it starts now or after 2 months or after 6 months, I don't know. There's lots of forces that could be the trigger. But it does feel to me that the dollar needs to strengthen, and I think it will, which will also take some of the pressure off RBI and the strengthening pressure off the rupee.
Jamal, so give us some levels. What do you think is the near-term range for the rupee at this point in time? Maybe in the next 3 months, you expect the rupee to be in the same range. Do you expect it to slide further against the dollar?
Well, it's broken through the range that was holding for a long time, right? So to my mind, you have to obviously widen the range, right? Last year was a year of unbelievably low volatility everywhere. And like volatility as much or more than most other things, when it goes way down, it turns up, right? What goes down does go up. So I would say if the range last year was, let us say, 63.50 to 68, I can't give you a 3-month range. I'd say probably 61.50 to 70 would be a range for a year. No, that doesn't help, but hey. That's life. Nobody can really forecast what's going on, as you all know.
Jamal, tell me, on this point about the RBI intervention that you were talking about, I think it was some point last year that some analysts came out with a report saying that the level of intervention risks hitting the US threshold in their currency manipulators risk. At that point, I remember I scoffed at it. I said, how can India be labeled a currency manipulator? If you're trying to do that, we're doing a terrible job of it. But since then, more and more people are saying that the amount of intervention or the quantum of intervention is actually hitting up against that limit that the US has in their list that they put together.
Well, I mean, the intervention is huge, right? Because they have to intervene, and it's still, the rupee is still pretty strong. But I mean, it seems to me that the US rule is a little odd, right? I mean, you would be a currency manipulator if you're keeping your currency weak. RBI is intervening to, well, it is intervening to prevent the currency from strengthening. I mean, I don't think India is a big enough player in exports, or certainly in its export basket to the US, for it to really attract this. But frankly, I haven't paid attention to it. My point on the intervention was really that, you know, if I remember the last 6-8 months of last year, forgetting about the forward buys, RBI bought about 30 billion in spot, and they sold about 12 billion in spot. Now I'm saying, why are you selling a single dollar? You know, I mean, because when you sell $12 billion, you're giving a signal that you are very happy with the currency in this tight range. Well, maybe they are happy with the currency in this tight range. I don't think corporate India is happy with currency in this tight range. And I think what they need to do is they need to at least take the top off. So the rupee could possibly have weakened to 66.50, maybe even 67. You will see more people hedging. You will see exporters getting a little more life, you know. The people are taking a lot of courage from the fact that October exports were up, or November exports were up 30%. But we are still below our exports of 2011. So, I mean, you know, come on, let's get real.
Jamal, last question, and coming back to the macros. Now, we've already seen the bond markets respond to fears on the macro front, fiscal front in particular. The currency market hasn't betrayed any nervousness so far. Is that because real rates remain high, so FI interest remains high, or is it that they just haven't woken up to it yet?
Well, clearly, everybody seems to be, Jiminy Cricket, right? Fiddling while the sun's shining. I mean, forget simply about the currency market, look at equity markets everywhere. You know, it's like there's no risks in sight. And there's always risks in sight. In fact, to me, one of the real issues is that you're not, a year ago you heard a lot of analysts talking about, this year I think we're going to see a collapse, equity collapse. I was one of them. We're not seeing too much of that anymore, which is a sign, when everybody says, hey, baby, I'm going to ride this horse, that's when it turns. So I think this year maybe it will be, finally we will see markets come down, and which I think they should, and some more volatility. The rupee, really, frankly, I'm surprised.
All right, Jamal, we'll leave it there. Thank you so much, indeed, for joining us. That's Jamal Mecklai talking about the currency and the direction that's headed. But let's move on and talk about what India is doing. India is adding the least amount of coal-fired power capacity in more than a decade. Tepid demand from distribution companies have led to overcapacity across the country, and plant load factors across fossil fuel-based plants have been below the average in previous years. Power Secretary Ajay Kumar Bhalla says he expects some pickup in demand in the coming years, and that losses of DISCOMs, or distribution companies, are indeed coming down. Listen in.
5 to 6% growth is there, and we are forecasting for the next 5 years growth of 6 to 7%. November generally is a low demand month in the winter times. December onwards the demand starts picking up. So November little lower growth is not a matter of worry.
Slightly nearer term, sir, because one tends to judge overall economic activity, or at least industrial activity, with the demand of power. Nearer term, have you seen a pickup or anything that would suggest that industrial activity is sort of reviving a little bit from previous levels?
It has. About 5% growth is there in this year up to November.
Okay, and no worries in terms of DISCOMs being able to pick up power, sir?
Yeah. Not as of now. See, as of the peak rated capacity, we are not falling short of any generation side. If the demand picks up in the coming months, as the core sector is growing, and we expect industrial activity, especially in steel, aluminium, cement sector coming up, so further downstream industries definitely will also pick up, and exports also are growing. So we expect the power demand to increase. If you have seen in recent times, the PLF on an average has gone up. In last 2 months, it is on an increase.
What are we averaging, sir, from the numbers that you have, PLF, say over the last 3 months, and what you would expect it to move towards?
See, it it has started growing beyond 57-58% now, touching 59%. Whereas, I mean, this is an average, whereas the NTPC average is all plus 79%.
When do you expect us to move to higher PLF levels? So what is the outlook in terms of PLF for the next year or two? Because that's a critical area in terms of power sector profitability. And as we've seen, it has been a difficult few years for the power sector. Joining this is also the question of some of the power assets that are currently in the NCLT or insolvency process, and your view on that and what that means for the sector.
See, I mean, as I said, pithead plants, the power PLF factor is definitely much higher than other plants. NTPC pithead plants will be much more. Average is 79 to 80% touching now. So PLF is on and up. I mean, of course, it varies from the state to state. Some of the older plants, capacities have been retired. About 7,000 megawatts have been retired. 3,000 more is in the pipeline. And accordingly, new capacities will be definitely getting market demand. As far as stressed assets are concerned, matter has been reviewed, and I mean, each plant has a different treatment to be given. Somewhere the bankers are looking at change of ownership, somewhere they are restructuring the debts, and somewhere where there is no nothing much has come on the ground, definitely the bankers have already gone to the NCLT. So different attempts are being made to revive some of these assets in a manner best possible.
So last year there was, a plan being discussed, or at least we'd heard there was a plan being discussed that there would be sort of a central role in these power assets, either an SPV getting created or NTPC taking over operations of some of these plants. Nothing came out of that, sir. Has that been sort of put on hold?
As I said, each asset is on a different footing. Some are commissioned plants, some have are yet to be, some units are commissioned, some are not. Some have a coal problem. So in Shakti auction, about 6 to 7 plants have availed that benefit. So those definitely will get into pipeline and start generating by maybe February end or so, once the coal starts flowing. Some of them do not have PPAs. So for that, we are working on a model that we can aggregate some power. NTPC has brought out an NIT asking for any plant if on a asset-based model to be taken over, if at certain basic price of, let's say, 3 to 4 crore rupees per megawatt. So they have not yet received any response, though many people have downloaded the document. So we are looking at that, whether some plants would be interested in selling their assets to the NTPC.
Okay, that's the power secretary for you. Let's move on. Now that Reliance Industries has commissioned the world's largest refinery off-gas cracker complex, the energy to telecom behemoth should turn cash flow positive within the current financial year, says CLSA. The brokerage also expects Reliance to start monetizing its Jio subscriber base in the near future. Some of the standing by to take us through some of those details and what CLSA is projecting. Sumit.
Yeah, so Reliance Industries consolidated free cash flow is expected to turn positive in the financial year 2018. Now, this is after 4 consecutive years of negative free cash flow. Now, Reliance Industries, which is one of the most valuable company in India, is expected to report nearly $1 billion of free cash flow as it has completed its capital expenditure cycle, and now these projects are expected to deliver returns in the coming quarters. However, the full benefits of this return of these projects will come in financial year 2019 as these projects get stabilized. Now, Morgan Stanley is expecting the newly commissioned refinery off-gas cracker plant to add around 10% to the consolidated EBITDA of Reliance Industries in financial year 2019. Now, CLSA in reports also mentioned some other monetization plans, especially of the Jio assets, which could lead to a good amount of cash flows for Reliance Industries. Now, Reliance Jio has around 15 crore subscribers and industry-leading data capacities, which can be monetized according to CLSA. Now, 5 ways how it can monetize it. Firstly, by gradually increasing the rates, which will also increase the average revenue per user. Second, by ramping up its 4G feature phones. Third, by launching home broadband service. Fourth, by starting enterprise solution business to monetize its wide optic fiber network. Lastly, it can also gain cash flows by selling differentiated products or services to its existing Jio customers. Now, Jio has around Jio's customer has around 4th largest customer base in India, and it can gain from cross-selling its retail products. Now, recently, Reliance Jio had launched its cashback recharge service, which also offered big discounts on offline and online retail purchases.
Soumya, thanks so much for that. Reliance to turn cash flow positive in FY18. That's the CLSA takeaway. Switch focus to the metal space. Global brokerages like Goldman Sachs, JP Morgan and Bank of America are turning bullish on Indian metals. What's the rationale? Nikki Mirchandani is standing by. Nikki.
Hi, Ira. A couple of brokerages on Indian steel sector. To begin with, Goldman Sachs, it has initiated a buy rating on JSW Steel with a potential upside of nearly 19% and says that the company is a preferred play, at least in terms of the low-cost converter that it is, and also the no raw material integration is also working well in the favor of the company. It also says that it prefers the companies or the steel mills which are not integrated as compared to the ones that are integrated because of the synergies that are going out of the raw materials. The robust margins, free cash generation and the healthy return on equity ratio that the company enjoys as compared to most of its peers is what is working in the favor of JSW Steel. It has also initiated a coverage on Tata Steel with a neutral rating and a potential upside of nearly 7%. It says that the company is expected to benefit from stable global prices, but it also says at the same time that these positive valuation or the stable margins have already been priced in, and it says that the valuation at 7 times its FY20 EV, that is enterprise value to EBITDA, seems to be fairly priced at this point of time. Overall, we also have another brokerage, JP Morgan on metal. It says that a very large iron ore price hike which have been taken by NMDC yesterday should also drive a price hike for steel players, but it on the contrary has a positive. It says the direct beneficiary of this move is going to be SAIL and Tata Steel, since they are the integrated players, along with your NMDC, which has taken the price hike. The other in the list, we have non-ferrous metals. Now, Bank of America Merrill Lynch has initiated a buy both on Hindalco as well as Hindustan Zinc. For Hindalco, it has initiated the coverage with buy rating and a potential upside of nearly 24%. It says that the company is uniquely positioned in terms of the cost leadership position and also its technical expertise. The upstream cost positioning has improved significantly while it does enjoy the margin that it's seeing in the downstream business. On Hindustan Zinc, it has initiated the buy rating with a potential upside of nearly 12% and a target price of 345. It says that it also enjoys the global cost leadership position, and the positive price outlook of the underlying metal is what is working for the favor. Zinc is the strongest. It says that this metal is the strongest fundamental among the base metal complex altogether, and also says that though the valuations are at premium as compared to both your peers and historically with the company, but then they are favorable given they're justified given that the favorable pricing of zinc and low cost positioning that the company is currently seeing.
Thank you for that. Let's move on. There are about 220 stocks that are tracked by at least 4 but less than 10 analysts on the Bloomberg. Some of them have the potential of being hidden gems in 2018. If the analyst target price is anything to go by. Jayesh Killan is standing by and he's drawn up a list of stocks based on yesterday's closing, and he's here to talk about which has the potential or the highest potential gain. Jayesh.
Afternoon, Harsha. So the stock that I'm referring to is Newland Laboratories, which is a pharmaceutical company that specializes in bulk drugs and intermediates. Now, the reason why we are doing this is because if you have a look at yesterday's close price, it closed at about 876 odd levels, and the Bloomberg consensus target price available on the terminal is about 1312 a piece. Now, which gives it a return potential of nearly 50%. Now, in this mid-cap space, or the lesser track companies, this is the highest return potential that we got for any company, and it has a market cap of less than 800 crores. And today also the stock is flat, so all these numbers stay valid. As far as the individual analysts are concerned, there are 5 of them who track this particular stock. 60% of them have a buy or an overweight rating, while 1 has a hold and a sell respectively. Now, the target prices that everyone has ranges from about 945 to 1800. So this is a wide target that we are looking at. And the lowest one, which is 945 by systematic shares, that too is in fact higher than where the current price is, which is close to 880 odd levels. So more than 50-60 rupees to be made over there as well. Now, if you look at the financials of the company, how they pan out, the first half of 2018 has not been that great for the company. If you look at the revenue picture, they've done in the first half just about 242 crores as compared to the full year of 572. Operationally also weak performance as far as first half is concerned. They've clocked only 25 crores of EBITDA versus the last year that they did was 88 crores, and significant margin contraction from 15.4% in last year to currently about 10.4%. And the profit picture too, looks very bleak, 32 crores or 33 crores in the last year as compared to just under 5 crores for this year. Now, there are reasons why these analysts are expecting that the stock can revive from here, or, the business can revive from here. So Dolat Capital, which has the highest target price and the most bullish comment, says that the API and the CMS business is likely to revive and, aid the earnings going forward. And the earnings profile is also likely to improve on account of the Newland Pharma Research merger that we are looking at for Newland Labs. The other one that we have, Anand Rathi, they have a hold rating on the stock, but they said that H2 FY 18 has not been will likely to be subdued. But the recent acquisition that they've done, which is going to address the capacity constraints that the company is currently facing, and that they're expecting earnings to revive going into H2 FY 19. The other one that we have is a sell rating on the stock, which is by Systematics. Now they say that why they have a sell rating, but the target price, remember, is still 945 higher than the current price, is because there are weak order flows for their key drugs, and also they say that improving business environment is likely to aid growth going forward.
All right, thanks so much for that, Jayesh. Appreciate it. That's an interesting one. Let's slip into a quick break, come back and talk about the Protect and Grow Jobs, American Jobs Bill and what it could mean for Indian IT.
Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world until now.
Just business news, we're news for business people.
Back on lunch, the headlines at this hour. Markets inch higher with both benchmark indices registering steady gains. Broader markets advance too as India VIX cools off.
Get ready for a geopolitical depression in 2018, says political risk consulting firm Eurasia.
Police impose Section 144 in certain parts of Mumbai and Thane to ensure the situation doesn't go out of control after Dalit organization called for a Maharashtra Bandh today.
All right, we will get to that big local story out of Bombay and Maharashtra, but first a look at the markets. Pradeep is here with a midway check on what's moving. Pradeep.
So market is actually trading with the positive bias, but there is no runaway move, at least in indices. If you look at the heavyweights, once they reach the upper end of the trading range, there is some kind of profit booking or shorting that we have seen. But mid-cap and small-cap are doing much better, and you can find several pockets which are doing quite well today. So you have all the fertilizer names like Nagarjuna, Fact, Madras moving up in today's trade, then metal and commodity stocks, chemical companies like Graphite, Rain, JSPL, they have all done well. So commodity is one story which is very strong, and global commodity markets also remain strong. So there is still momentum, and on any decline there is enough buying interest and a fresh run up as soon as the market turns, like in today's trade. You also have some of the names like Precol moving up, Sagar Cement, with some institutional buying interest coming in at these counters, which is also reported. Then we saw VST Tiller posting excellent growth numbers as far as the month-on-month sales is concerned. There was a base effect, but still 50% plus kind of a growth was enough to drive this stock up. So that also figures among gainers. There is not much churning, but a few pockets like, for example, RCOM is finally tiring off. Second day in a row, we have seen some profit booking coming in here. Insurance, which has remained a favorite bet among traders, is also cooling off. Two more stocks I would like to mention here. 3i Infotech has seen a sharp run up. There were talks of some kind of corporate development, some news flow that people were expecting. And now looks like there is some profit booking at higher levels, and also in Peninsula Land that moved up over the last few days. So net there are much more gainers than losers in today's trade. If you look at the overall market, picture is completely inverse of what it was yesterday at the same time.
Thank you so much for that. Let's focus now and talk about what's happening in this Indian IT. NASSCOM has come down hard on a proposed US bill which looks to protect and grow American jobs. The industry body says the bill is riddled with onerous conditions and places, and I quote, unprecedented obligations on both Indian companies and at their clients. Joining us to talk about the bill in specific and the issues concerning around it is the NASSCOM president, Mr. Chandrashekhar. Chandrashekhar, thank you so much indeed for joining us. Let me begin this conversation by asking you about what the concerns are, and what kind of implications will this have, is this likely to have, if this gets passed on the Indian IT sector?
See, first and foremost, the bill seeks to impose a condition on the company and the business that is hiring the Indian service provider. And the conditions are such that the company that is hiring them needs to guarantee that they would not displace any worker during the entire period for which the visa worker is deployed with them. Also that if the provider of the services, that is the IT company which is providing the services, comes to know of any such displacement, they will have to notify the US authorities, and they will have to withdraw from the workplace, meaning thereby that they will have to in effect abrogate the contract. All of these are unprecedented conditions which actually not only get into the innards of a commercial undertaking, but also which in a sense impinge on legally binding contracts. It is these concerns which have actually also made the US Chamber of Commerce come out and say that these proposed changes constitute an unacceptable intrusion into the working of businesses in the US. The other point of concern from the Indian IT industry's perspective is that these conditions are applicable to visa-dependent companies. And again, the visa-dependent companies are being defined in such a way that it impacts only the Indian companies. Any company which previously had more than 15% of visa workers was regarded as visa-dependent. That definition is now being tweaked under this guideline, under the bill, to 20%. Which is basically aimed at keeping non-Indian companies which are significant users of H-1B outside the purview of this amendment, and restricting the impact largely to Indian companies. So I think these are all significant concerns, but the bottom line is that these amendments do not serve the very basic purpose that they were supposed to serve, namely to protect job opportunities for American workers.
Sure.
On the contrary, since a large percentage of companies that use visas would not be covered through this amendment, it is certainly going to be ineffective as far as the stated purpose is concerned. So from every point of view, it does not make logical sense.
Sure. So just one, slightly broader point. If I understand this right, many Indian companies over the last couple of years have been steadily reducing their dependence on H-1B visas. Correct me if I'm wrong. There was a time that 50% of H-1Bs given out were given to Indian companies, were given to Indian nationals. We were given to understand that that's been continuously coming down. Now, you're also saying that this bill says the extension to H-1B for those who are waiting for a green card will not happen. Could you sort of quantify or give us some color on the number of workers who would be in this category?
No, I think there are several different issues which are getting mixed up in this question. Right. First and foremost, if you take the number of visas, 70% of H-1B visas, roughly 70%, go to Indian nationals. This covers both Indian IT companies and non-Indian IT companies, American or other country IT companies, which serve the US market. And it also covers non-IT workers, doctors and other professionals, for example. So while the number of visas, the percentage of H-1B visas, 70% of it goes to Indian nationals, the percentage that is used by Indian IT companies is only 15%, which is less than 10,000 actually. And the number of visas used by Indian IT companies, not companies working out of India, but Indian IT companies, that has declined by more than 50% in the last 2 years. So there's what you said is absolutely right, that companies have been bringing down the usage of the visas. The other aspect is about the fate of people who have applied for green cards, and that's a separate action that's not coming through the legislation, but it is apparently, from reports that we have, being contemplated as an administrative action, because the authorities do have the right and the power to adjudicate on applications for extension of the H-1B visa. And typically H-1B visa is issued for 3 years and extended for another 3 years, so it could go on for about 6 years. But when a H-1B worker applies for a green card, and when that application is accepted, then the extension of the H-1B visa has been more or less automatic so far. What the contemplated action seems to be suggesting is that the authorities could exercise their discretion and not grant extension, which means that even though the person has applied for a green card and even though that application is under consideration, once the extension of the H-1B visa is not given, the person loses the visa status and would therefore have to leave the country.
Right.
It doesn't mean that it will happen in all the cases. Even this provision has not actually been put into action at the moment, but these are apprehensions, and there is no doubt that these are significant apprehensions.
Mr. Chandrashekhar, we'll leave it there. Thank you so much indeed for putting this in perspective. Not good news. This is at a proposal stage yet, but at this point in time, it doesn't look good for Indian companies and the Indian IT industry in particular. That's the NASSCOM report for you.
All right. Meantime, the situation in Maharashtra remains tense, but there have been no reports of a big clash or damage to public property today. Dalit organizations have called a statewide bandh today after major clashes broke out between Dalit and Maharashtra outfits. First in Pune on Monday and then spread to Mumbai on Tuesday.
The police and railways have been putting out regular updates on Twitter, and while there have been sporadic instances of suburban train services being halted, major road arteries are being blocked. The situation has been by and large under control so far. But the bigger question is, why is Mumbai being held hostage? Joining us on the phone line to give us a sense of what's going on, Kumar Ketkar, senior journalist who's been tracking Maharashtra politics for a very long time. Mr. Ketkar, thank you so much indeed for joining us. Well, the Dalit organization who've called for a statewide bandh today, they've been, as I mentioned, sporadic cases of stone pelting and in different neighborhoods. Can you give us a sense of what the genesis of this problem is and why has this spiraled out of control?
Well, the genesis of the problem you have to locate. For last 2 years, the Maratha community, like Patels in Gujarat and Jats in Rajasthan, have been seeking reservation. Maratha community has been seeking reservation. They are not included in the OBC list. The only people who get reservation are Dalits and section of the OBCs. Now, Dalits and OBCs, one may feel, how is that connected with this riot? But there is, just wait for a while and you will get the connection. So these people were angry and they took out something like 52 marches, each march of not less than 3 lakh Marathas participating to demand reservation. Now, as a result, there was a panic in the Dalit community and the OBC community against Marathas because they are the largest number of community in Maharashtra, largest meaning more than 4 crores in a population of 11 crore are Marathas. 4 crore is equal to population of California and they are protesting. So Dalits and OBCs were angry and were actually, the anger was brewing among Dalits and OBCs against Marathas. Now, Marathas have been ruling the state for almost all the years ever since Maharashtra was formed. This time, the chief minister is Brahmin, but that has very little to do because only 3% of the population is Brahmin. Majority of the population is Maratha. And the Marathas seem to dominate almost all sectors of life, from sugarcane, from the Jilla Parishad Panchayats, from the assembly, everywhere Marathas dominate. That does not mean that all Marathas are well off. A section of Marathas are very poor also. The problem in this particular case of Bhima Koregaon is when 200 years ago a war was fought, because of the untouchability and the discrimination, the people who were Dalits, who were untouchables, who actually welcomed the section of British because they thought that the law and order will come and their discrimination will end. So they actually supported the British, participated with British against the rule of the Peshwas. Actually, it was not a rule of Peshwas. It was rule of the Chhatrapati, but Peshwas were running the show. So they protested against that and joined the British army and defeated the Peshwas. Peshwas meaning Brahmins.
Right.
Now, because the Dalits participated with British to defeat the Brahmins, the conflict emerged between the Brahmin organizations and Dalit organizations, and this was further accentuated by the person called Sambhaji Bide, who is a Brahmin himself, but runs an organization essentially of the Marathas. This is very complicated. Most of the readers or listeners or viewers won't easily understand this complexity, but even then, it is necessary to understand it is essentially a caste conflict, a triangle of Dalits, Marathas and Brahmins. Now, because Peshwas were Brahmins and they were defeated, the section of the Brahmin organizations, which are all linked by definition, all these Brahmin organizations are linked with the RSS. And therefore, the charge that RSS is behind this is absolutely justified charge because the chief of the RSS organizations, local organizations, are supporting the agitation. And therefore, it is necessary to understand Dalit versus Brahmin versus Maratha community triangle.
Okay. Mr. Ketkar, the politics of this, how do you think the government has reacted so far? And it looks like the Fadnavis government has been under pressure. As you mentioned, this is not the first time you're seeing many of these caste-based protests coming together and holding the city to ransom.
Yeah, absolutely. And the reason they chose Bombay or the reason they chose Mumbai for the kind of protest is justified because they know, like everybody knows nowadays, that unless you protest in Mumbai, the national media will not take note of it. If the same agitation was to take place somewhere in Ahmednagar or Chandrapur, this would not have happened. It would not have become a national issue. It would not have figured in Lok Sabha. So they know it. So to make the issue actually well known and to make the grievance, if at all, well known, they chose Mumbai. And that's why, and Mumbai also has a history. Ramabai Nagar, where a police was accused of hitting and shooting the Dalit community, was actually a big issue in Maharashtra because the police was Maratha and the community was Dalit, which was attacked and shot at. So therefore, it has been going on and on. It is not something new. Unfortunately, nobody recognizes Maharashtra as a caste-based society. Everybody recognizes UP and Bihar are caste-based societies, but no less is Maharashtra. And therefore, it is necessary to understand that the genesis has been growing. I mean, anger was brewing for quite some time. Maharashtra government is in a fix. Maharashtra government, which is directly linked with RSS, Devendra Fadnavis himself comes from Nagpur, very close to RSS headquarters, and he's directly RSS man. Now all the people who are behind the other organizations which attack Dalit, if they are RSS men, he is in a fix. He cannot defend them and he cannot offend them. That's why there is a big problem. So he is merely saying that inquiries have been ordered, but so far he has not arrested any of them, because to arrest, and more important is, Narendra Modi himself is a big admirer of the chief of this organization named Mr. Sambhaji Bhide.
Okay.
He is 85-year-old, but he's an old Hindutva, very old Hindutva hand, old Hindutva fanatic, and Narendra Modi himself supports him, and therefore it is very difficult for them to actually arrest.
All right, sir, we've run out of time. Thank you so much indeed for putting that in context for us, but the situation across the city remains tense. Kumar Ketkar giving us a view on that.
All right, from local Maharashtra politics to geopolitics, you've heard of an economic depression. Well, you may now want to get ready for a geopolitical depression. Eurasia Group, a political risk consulting firm founded by Ian Bremmer, has forecast that 2018 will be the geopolitical equivalent of the 2008 financial meltdown. Menka Doshi has been reading through that report and joins us with some of the key risks that they highlight. Menka.
Yeah, well, you know, it's an interesting report, not because everyone comes out with 2018 risk reports, but mostly because, you know, I think if you follow Ian Bremmer, he's amongst the few that had been able to forecast and been rather prescient about it, or 8-10 years ago, a G0 world, a world with no established leadership, thanks to the sort of the deceleration or the diminishment of Western power. And so therefore, you know, I think if you followed some of Ian's work, this becomes a little bit more prominent. And I thought some of the risks sort of listed in this report are definitely very, very interesting. But before I get to that top 10 list of risks, two interesting comments made in the opening of the report that will strike a chord with you. I think the first comment that they make is a very uncomfortable but real take on our world today. It says the scale of the world's political challenges is daunting. Liberal democracies have less legitimacy than at any time since World War II. Today's strongest leaders show little interest in civil society or common values. And I think, you know, this will strike a chord across countries, nationalities, and therefore the report says that, you know, after a decade of slowly destabilizing G0 framework, we're now seeing, or we're now closer to geopolitical depression than to a reversion to past stability. So that's how it sets up the case for a potential geopolitical depression. Now, 10 risks, and many of these may seem, you know, sort of fairly familiar to you. These are the 10 that are up on your screen or will be up on your screen. China loves a vacuum, the accidents that could take place this year, global tech, Cold War, Mexico, US-Iran relations, the erosion of institutions, protectionism 2.0, United Kingdom, identity politics in Southern Asia, and Africa's security. I picked only a few that I thought were interesting, especially where the observations were insightful. So the bit when they talk about China loves a vacuum, I think the report does a really good job of contrasting the very strong leadership that China is currently experiencing, probably the strongest since Mao under Xi Jinping, and in contrast, President Donald Trump, who probably represents the weakest leadership that America has seen in decades, right? And then it goes on to make this very interesting point about an inversion that none of us really expected, but have possibly witnessed quietly over the last several years, which is that for decades the West thought that it's political reform in China that's necessary, that a rising middle class will put that pressure on the political structures in China. Well, that reform didn't take place, but instead today you see a political structure in China that's far stronger than the political structures in the West, especially in the US. And I thought that observation was really interesting. In this leadership vacuum of a G0 world, the report makes the case of China maybe coming in to take pole position, and in being able to do that, it will also have the opportunity then to set some international standards in global trade, in technology. And one critical thing I thought the report said that was interesting, that might make China's leadership more palatable to other countries, is this political value that it has of non-interference in other countries' affairs. Now, we can debate that. Not all countries will agree with it, but relatively less interference than the US and the West have had, I would imagine. That might make China's leadership more palatable. So that was the first important risk in that. One of the other important risks, and we're seeing that play out over the last several days, is the US-Iran relation and the flashpoints thereof. The report suggests that there could be a failure of the nuclear agreement and that there could be secondary sanctions. but it's anybody's guess how those secondary sanctions will pan out, because definitely countries like India and China didn't stop buying crude from Iran then and are unlikely to, at these crude oil prices, stop buying crude from Iran now. So what the success of that will be is yet to be seen, but the report concludes that the threat of US and or Israeli strikes would again hang over the region and boost oil prices. So that's the US-Iran relationship. One thing that struck a chord with me, the erosion of institutions. We've been discussing this for months in most newsrooms across the world, whether it has to do with fake news, whether it has to do with rigged elections. It keeps coming up in different parts of the world, whether it has to do with the politicization of institutions itself. Here's what the report says. It says institutions are guardrails, strong courts, and media, lessen dependence for stability on powerful and sometimes erratic individuals. So if you don't have strong courts and if you don't have strong media, then you have powerful and erratic individuals leading the world, and that's of great concern. And I think finally I'm going to end on what they had to say about identity politics in Southern Asia. So they're not just referring to India, but they're also referring to maybe the rise of Islamism in countries like Malaysia and Indonesia. And then they finally also talk about the rise of Hindutva in India. And here's the final quote I'll end with. The report says, in India, the danger is that Modi's use of nationalism to consolidate his support ahead of the 2019 election could give cover to radicalized elements of society that want to target Muslims and lower caste Hindus, leading to risks of localized instability. It's an interesting report. You can go to the Eurasia site to read it. And if you want a prescient, shorter version of it, you can go to the BloombergQuint.com site to read it, where we've put up some of our key takeaways from the report.
Thanks for that, Mecklai. In fact, Tom Keene from Bloomberg and Francine Lacroix caught up with Ian Bremmer and Dominic Barton of McKinsey and Company, Dominic Barton of McKinsey and Company, to understand what they consider are the biggest geopolitical risks. Some explanation of what Mecklai just spoke about.
When the global economy feels the way geopolitics do today, people respond. They see it's a crisis. They know they need to do something. They got to bail things out. They got to do infrastructure projects. They got to get the banks ready, right? We had that back in 2008, and everyone knew. Dom and I talked about this. You and I talked about this. We all knew it was a crisis. We had to respond. The geopolitics are easily as bad today, globally, as the economics were in 2008. They might be worse, and yet there's no crisis. There's no sense of we have to respond. In fact, if you look at the Americans, the one superpower in the world today, the one country that could conceivably help to respond to dig us out of this crisis, is actively doubling down. We're saying we have no intention of providing the kind of certainty to our allies, of supporting the institutions. So as a consequence, anyone that looks at the geopolitics today has to understand this is not sustainable and that crises are coming.
Don Barton with us as well from McKinsey and Company. Without question, the top think tank research on the street. Your McKinsey Global Institute is just a miracle what you do there. I don't care about that. I want to know what businesses are going to do this year. Dr. Bremmer talks about accidents. You can't do 3 or 5 year planning amid a milieu of accidents. What do you see in the behavior of C-class officers this year?
Well, it's the yin and the yang. You have to do, there's growth. I mean, the one thing I don't want to get too depressed, because I think there is growth that's out there, and we should recall that over the last couple of years we've seen that improve. I think the challenge is you have to go after that growth, but at the same time be prepared for these risks. And it's interesting, the number one risk that CEOs see out there is geopolitical. That's the number one risk. And the problem with those risks is they're not probability curves. They're 1 or 0. If something goes pear-shaped, it's bad. So there's issues about your resilience. So while you're growing, what are you doing for resilience? What does your supply chain look like? Will it withstand? How will it withstand some of the shocks that Ian is talking about in the risks that are there? How do you think about agility in your organization to be able to move resources very, very quickly? And then also recall that we're in the midst of a massive technology transformation, the digitization of everything.
And we're going to talk to Brad Smith about that. Francine, please jump in here from London.
Yeah, so Ian, is 2018 the year that protectionism strikes back?
2018 is certainly a year where we see a much greater fragmentation of the global marketplace because governments are becoming more interventionist. And part of that is because the Chinese have an alternative model for their investments, and they're going to be seen as increasingly the most important driver of other economies around the world who will align themselves more with Beijing than with Washington. Part of it is that President Trump here in the United States, who in 2017 talked a lot about protectionism, talked a lot about beating up on trade deals, but aside from leaving the Trans-Pacific Partnership, didn't do very much. In 2018, the U.S.-China economic relationship gets worse. In 2018, NAFTA has to get renegotiated in the midst of a Mexican presidential election. That's not likely to go well. So clearly, this is a year where we're going to talk a lot about not only traditional tariff barriers, but also non-tariff barriers and government support / protectionism for their own industries at home.
Ian Bremer from Eurasia. Out of time on the show. Thank you so much for watching.
Good afternoon. Countdown is up next.